Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook and your host for about the next 20 minutes here on Options Guy TV. All right, so this week we're getting to the heart of earnings. We're going to look at a trade in 3M today, and then I'm also going to get bearish for the last week of October, and we're going to look at one of my favorite indexes of the trade, the good old S&P 500 index, and we'll see. We'll put on a new trade to try to go along with a little bit of the bearishness that we're seeing in the marketplace right now. Not to mention that the VIX just does not want to come down. The VIX is trading right at 19 at this point in time. We got the S&P 500 index down about 0.5% or 30 points, and that weakness is across the board. The Russell is heading the markets lower the most right now. The Russell right now is down about 1.5%. Or 31 points on the good old RUT. And then the NASDAQ is fairly similar to the S&P 500 index. That's about almost 0.5% at this point in time. So I'm going to feed into that weakness and look at doing a butterfly in the S&P 500 index. We left last week without a trade. We did a trade in Netflix that worked out. In general, it wasn't a home run, but it did make some money on that trade. And this week, we're going to hopefully do the same thing with MMM. We also have Tesla. So on Wednesday's show, we will be doing a trade in Tesla around their earnings. We'll come up with something that'll be fun to do around that earnings report. But the S&P 500 index, this is the last week where I really still have the bearish stance in general. I shouldn't say, week in and week out, things change. But the election is not far away. That known event would be excellent to get away as far as the markets are concerned. Once that passes, it frees the market up. The S&P 500 index is pushing for that 6,000 mark. It's at 5834. And I think, as I mentioned before, you want to put your order in right now for that SPX 6000 hat. You don't want to be the only one at the party without it. So it's time to put in, get that hat made for you. And I think going into the end of the year, we'll probably see that number in the S&P 500 index. All right, so let's start with the MMM trade. And this one's just going to be a simple trade. I actually, as far as 3M is concerned, a little bit more bearish than have been previously in 3M. And I am going to actually just do a short call spread. Feel fairly comfortable going out one standard deviation move going into that earnings event and just getting short some premium. And I very rarely do that without doing some form of either skip strike butterfly or something a little fancier, I guess, than just a flat out short spread. But I think the path of least resistance in 3M is going to be to the downside. Right now, we see the market is actually down $1 in 3M. So let's run to the Tradier Pro software. Let's set up that trade. 3M is going to be announcing before the open tomorrow. So we'll know about this trade fairly quickly. I'm going to use the shorter term option contracts. 3M's a fairly expensive stock, $134, which gives us a little bit of premium on that trade. And we're going to just make it a very short and sweet trade. We're going to look at about a one standard deviation move out in time inside the Tradier Pro software. One of my favorite things about the options grid is that it kind of highlights between the black and the gray where a one standard deviation move is at, and you can always confirm that by looking at the delta. We do actually have some open interest here right at the strike. So we're going to have a fairly decent market. I want to be at least one standard deviation away, and we should probably just quickly check out the expected move. So let's go and click on this and buy the ask on the call and buy the ask on the put. And we see that right now that is about a 10% or a 10-point move in the underlying stock. That on the upside, remember, expected move doesn't have anything to do with direction, so don't forget that. And that we'll call it 11 points. We'll round up. It's not an exact science. This just means that if you were to buy the long straddle, another way to think of it is the over-under on the earnings report. Now, this is going to go out until Friday, and they're going to announce on a Tuesday, right? So it adds a few more days in after that earnings, but this is what a lot of people consider to be the expected move on that underlying stock. And we're going to call it 11 bucks. Right now it says $10.60. So $11 would put you at 145. Okay, so I want to go beyond that. And I'm going to run up and look at the actual one standard deviation move. So the marketplace is pricing in about an 11-point movement. No regard to direction. That could be the downside to the upside. And if you're thinking of this as a betting marketplace, what we would call this is the over-under. Do you think the market after earnings is going to move more than 11, or do you think it's going to move less than the 11? If you think it's going to be more, that means you would buy the long straddle. And if you think it's going to be less, that means you would sell the long straddle in this instance. I personally think the market is, well, I not necessarily to get into the fundamentals on 3M, but I feel like the stock, just the charts and everything that's going along with this company is leaning a little bit more bearish. And I want to go at least an expected move out in time because implied volatility is jacked up. Right now, we're showing it at 93% implied volatility on this short-term option contract. The ones that we're going to be selling is showing about a 90% implied volatility. So there is some juice in that trade. So here's the trade that we're going to do. Very straightforward. We're going to sell the 148 strike put. We're going to get about $1 for that. So I'm going to click on that. And then we're going to go out and we're going to try to get at least 50 cents for this trade. So on this instance, the 152.50, which is 60 cents by 35 cents. It's okay. It's a half-point strike. There's still not as much open interest as if we do the 155, but that's 7 points away. I really wish there was just a 153. So in this instance, we're coming close to getting that 50 cents. I think we're going to do the 155. We got a lot of open interest on this. There's probably a spread that came in on this trade anyways, because if you see there's 1,000 contracts here and 1,000 contracts there, so good tight markets on it. You would expect that they're the most open interest besides this 135 strike. So I'm going to sell. Yeah, let's go a little bit more. Let's do the 155. I changed my mind. I don't think I want to do the 152.50. So this is going to be 7 points wide. 148 is what we're selling. We're buying the 155. We're going to bring in a net credit of 70 cents to the account. And our maximum risk will be that 7 points minus that 70 cents that we brought in. Our break even would be the 148 plus the 70 cents or 148.70. And we just want the market to stay below that implied volatility to come in as soon as the trade goes off. So I'm looking to probably get out of this trade before 10 o'clock tomorrow Eastern time. Market's open at 9:30. We're hoping the market actually, if the market opens down, I'll let it ride a little bit. If it opens up a little, maybe a one standard deviation move to the upside, I'll probably end up taking the trade off. There's a few days left, but implied volatility should come in. If I could get this trade off and close it for about 10 cents, definitely want to do that, or even half of that net credit. So we put it on for 70 cents. If we can score 35 cents on this trade, that is what my outlook would be. And that's 35 cents for every 1-by-1 short call spread that we put on. As I said, I would normally in these scenarios, I would look at doing a skip strike butterfly, but I do like to change some things up. Skip strike butterfly as an alternative to a short spread. That's the way that I always like to look at that trade. So if you have any questions, please do put them in the chat box. If you are in the Tradier YouTube channel, you can do that. If you are inside the Tradier Hub at hub.tradier.com, you can also ask questions via the Hub. And you can also follow me on Twitter. We do stream these live through the TradierX.com profile and through my profile, which is at Brian Overby. It's at my name, at Brian Overby. All right, so this will be the official paper trade. I'm going to send it to the what if calculator, and I will end up grabbing a screenshot of this trade, and we'll look at it. We'll look at it on Wednesday, and that's one of the wonderful things about doing the earnings trades is that we have 3 shows a week of Options Guy TV, so we know the answer to our trade if we're just doing an earnings trade. But this is the setup that we have. The stock is here at 133.97 inside the what if calculator. This is where our risk kicks in. 148.71. We said we did it for 70 cents, but it's added a penny to it, so the market moved just a fraction. And our risk kicks in all the way down here, and our maximum risk is that 70 cents minus the difference between the strikes. Or if you look over here, you'll see where the maximum risk is at $630 for every 1-by-1 spread that we put on. You'll have to have that as a margin requirement inside your account, and you can actually do these trades in an IRA account because it is a defined risk. So if your brokerage firms allows you to do it inside an IRA account, you can put that trade on inside an IRA account. All right. Any questions? Now would be the time to ask on this trade. If not, let's go in and get bearish the market. Okay. Now, if I'm going to look at doing a bear trade, just my general go-to is to target a price below the market using a put butterfly in the S&P 500 index. So if we type in the SPX here, and we're looking to do our trade, we're going to just go a little bit below the market. We're going to go about 20 points below. We have the S&P 500 index, the VIX trading at around 19. So this is going to be fairly inexpensive. When implied volatilities are increased, when you're first putting on your butterfly, the market, it'll be cheaper with higher implied volatilities. Now, if you're correct on your forecast, you would prefer that implied volatility would go down. If we're doing it on the put side of things, that's probably not going to be the case. But we're doing such a short-term option contract that time decay is our friend. We're going to put this on Monday. If we have to make an adjustment, we'll probably do that on Wednesday's show on Options Guy TV. If the market does go down, we need some time decay to happen, and we'd like to reach that short strike. In the S&P 500 index, where you see the largest amount of time decay is from Wednesday to Friday. Wednesday night, it seems like we lose a good chunk of at-the-money time premium in the S&P 500 index. And then from Thursday to Friday, obviously, then it's like, wham, my sled hit the tree. A lot of time decay happens, even in the last half of the day on Friday. All right, so the market's at 58.30. Let's go down 5 points, and we're going to start there, and we're going to go 20 points wide on our butterfly. We want to use this Friday's expiration, which this Friday is the 25th. Okay, so here's the 25th. I guess I could have looked up there and got the information that I needed. And we're going to be buying the 5 point out of the money. The market's right now at 58.30, so we're going to buy this one. We're going to go down 20 points to the 805, and we're going to sell 2 of these, and then we're going to modify this a little bit. So now we're going to only go 15 points. I'm going to have to pay up a little bit more for the butterfly, but 15 points lower would be 55.90. Now, the difference here is 25 cents, right? If I just look at the ask from 101 to 105, so we got to pay a quarter more for this butterfly, but that means if the market does tank, we can still be profitable on this trade. So I'm okay with that. So a standard butterfly to go down to the 57.85 would be approximately $3. We're going to pay $3.25. And I'm going to send it to the what if calculator. I'm going to tell you why we're going to pay that extra 25 cents. So if we look at this trade, we want the market to go to 58.05, down about 20 points, little less than 0.5% in this trade. Well, it'd be 25 points. So right now the market's down a 0.5%, it's down 34 points. So we would like the market to do that, and we'd like it to drift a little bit lower, and it can take its time getting down there. We'd need a couple of days of time decay to make this profitable. But if it goes to 58.05 and it happens instantly, we should be up about 75 cents on the trade. And if we do that, just get out. I don't mind that. If the market keeps going south, we're still going to be okay on the trade. But if we got that opportunity instantly and we don't have to worry about adjusting the trade, I just take it off. Now, if I'm a little bit closer to the expiration, if I'm on a Wednesday or Thursday, it's much more interesting to stick in the trade because theta is going to be very large on Wednesday or Thursday if we look to put that trade on. All right, so let's send this to the what if calculator. Well, it's not listening to me. I said send it to the what if calculator. There we go. Sometimes my computer doesn't listen. All right, we're going to knock this down, come down here. Let me put these clicks in. Boom. 1, 2, 3. All right, that just makes it to be able to send it to the trade ticket easier. And I'm going to zoom in on this trade a little bit. Here we go. And let's do one more. Okay, so here's where the market is at. 58.30. There we go. It's behaving. It's staying a lot of times because we do tape Options Guide TV live. So sometimes the markets don't behave and they start moving a lot and screwing up my math. But in this case, they have not. We're looking at $3 and, well, it's actually moved a little bit here, but 325, I definitely feel like you can get a fill. Very, very liquid, very, very good underlying to trade in. The S&P 500 index, good old SPX. If the market goes down and it goes to this strike, okay, to start with, we're not going to be not hitting a home run, right? We need some time decay to happen. So initially, if the market goes down, we'll be up a little bit on the trade, but not a lot. And as expiration approaches, eventually you'll go towards that TP. And like I said, a lot of that happens on from Wednesday to Thursday and Thursday to Friday. That's where you see a lot of that happening. The market goes all the way down, though. This is the reason why we like this, why we modify it. We pay an extra quarter because if the market does go down, we can make money. Notice this is the zero line here. But from this strike, which is our 57.90 strike, all the way on down, we're still making basically the butterfly would be trading for $5. So in our instance, we're jumping around a little bit, but we're showing that you can make $192.50 at expiration. What it would be is the difference between this and $5 because the difference in our width of our strikes inside our butterfly is $5, right? We're going from 58.25 down to 58.05. That's 20 points. From 58.05 down to 57.90, that's 15 points. So in that instance, that means that we have $5 of, well, basically the butterfly would be trading for $5 if the market goes down below our lowest strike at 57.90 on down. Subtract the $3.25. That means we would be up $175 on our trade if the market truly tanked. But if the market just kind of drifted down, we'd do okay. I still would get out of the trade. If the market starts going up, we're going to do an adjustment. So on Wednesday, I usually try to adjust them on the show. They are considered paper trades. But if we do see the market drift up a 0.5% by the Wednesday show, well, I would adjust this and roll into a short put spread. And that's the way that we're gonna adjust the trade. I do see we got a comment though. Let's see where we're at. Your expiration is not 10/25. It's not. Well, why is it not? Oh, and it's still $3.25. Wow. You're right. Thank you, Anthony. Let's do that. $3.25. That's an interesting trade just in general for one, because this is the October 21st, and it's trading for $3.25. So I'm guessing. Let's do the guessing game here, Anthony. So this should be maybe, gosh, $2. I think this will be closer to $2. Let's do it. Let's save this one. We sent that to the what if calculator. I don't mind that trade today if you want to get bearish on it. If you do think that we'll go down 1% today as opposed to a 0.5%, which is a real big move in the S&P. Let's go to this date. All right, and we'll do the same trade. So let's clear this out. Buy. Go down 20 points, 805. Oh, wrong side. Dang it. Buy. Sell. And then 790 buy. 285. Not a huge difference. I thought it would be trading with that much more time premium. So 290 versus 325. Where's the market at? It's gone down a couple of bucks, which would have hurt it a little bit. But 58.25, 58.05. Okay, got it all set up. Yeah, so let's go to, I'm going to say 280. I think you could get filled at 280 on this, the way the market's moving. Open interest. Yeah. All right, so this is going to be the official paper trade. And it's just a few dollars difference. Well, maybe we could look at the Wednesday one. Let's send. I don't want to digress too much. Loading up the what if calculator. Let's zoom this down. It's going to look at everything that I said in the beginning trade is going to apply. So we're still at the same situation, except for you notice that this is not as loopy as the nearer term option contract, mainly because we do what, like I said, we need a lot of that time decay. So I don't mind that trade right now. I guess it's probably because the VIX is elevated, trading at 19 right now, a little bit higher implied volatility. These IVs are only around 12 though. Yeah, I don't mind that trade actually. You know what? Let's keep them both on. I'm going to, I got this in the what if calculator and that one. Let's look at the mistake trade that I made that Anthony pointed out, that where we did $3.20 on the October 21st expiration. But the 25th trade will be able to adjust. If the market were to open up tomorrow, we could make an adjustment to that trade. Or by Wednesday, the market started bouncing back. So let's do both of them. I like that. So we got 3 trades. So one show, 3 trades. You know, don't want to toot my own horn, but that's what I think we're going to do. And I see Doug's got a couple of questions. All right, Doug, go ahead and toss them up there. I am still traveling, so I got a little bit of a different situation. I didn't notice the strike off, but I did wonder why the today curve was so curvy. Yeah, you're right, Doug. Doug said that very well, and you can see it on the screen. I like your I like the way you wrote that, Doug. I did wonder why the today screen was so curvy, and yeah, there you go. Let's leave that one on. Excellent. Okay, so let's do both of them. I'm really surprised, bluntly, I'm being blunt because I've done a lot of butterflies in the S&P 500 index. And I'm surprised to see that the 25th date, here's the 3rd, 7th, okay, the 25th date, that this is actually not trading closer to $2 with the VIX at 19. Whereas this date, let's run to the what if. We got okay, I got them all in. 1, 2, 3. Okay, so I can take screenshots of all 3 of these. And we can go back to the initial one. So this is the one right here. You can screenshot that if you want. We're going to say it's $2.80. It's going to be the same scenario, but instead of paying $3.25, we're paying $2.80. And let's go back and see. The market is now not behaving. And that's the 280. Nope, that's not the 280. Let's look at this one. Okay, let's send this to ticket and go back to the trading screen. Yeah, 380 now. Okay. Wow, it's already up $4. Well, do you want to close it? We put it on for 320. We're up 80 cents. Not bad, huh? Market went to 58.26. Down about another 6 points from when we put the trade on. At least at the beginning of the show. All right, we're going to follow these. I like it. What do you guys think? All right. I think we're going to leave it here. Done a little bit earlier. We're pushing it. Okay, so we made it. 3 trades. We're going to look at the short call spread in MMM. Very rarely do I just do sell premium mainly because you can't adjust it if you're doing it on a short-term basis like we are in 3M. They are announcing on a Tuesday, so you do got Wednesday, Thursday, and Friday. And it's a little bit more of a pricey stock, $134. So we might be able to make an adjustment if the market doesn't just blow us away, right? Blow through our short strikes. And then I like the trade. I like the trade on the October 21st. I can't believe that thing was trading for $3.25. That was fairly inexpensive. And the market is now moving in the correct direction. And, it must know about our trade, so it's moving that way. And then we'll come back and look at the October 25th expiration, and we'll do this on Wednesday at 11 a.m. Eastern time. You don't want to miss that show. It's going to be fun. Tell all your friends and families about it, and we will see you Wednesday at 11 a.m. Eastern time for the next edition of Options Guide TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.